funny now that my series has completed and it's gone worldwide, and that's how the truth works. I'm certain you haven't watched it because the majority opinion is that she was born a man now. And that's because rather than allowing people to just say it was crazy, I just took the time and showed them all of the overwhelming evidence that it was true. Look, we live in a time where there are transgendered people. Brigitte.
All right, let's go through some of these JFK files. All right, so as you guys can see, the JFK files just got dropped. We're here on the website, Assassination Records, and these are the records that came out in 2025. Matter of fact, let me see. Let me message Corey.
Yo, I'm not gonna lie. I'm gonna dedicate one live stream of just looking into Candace Owens' Macron allegations, and bro, that shit was hilarious, bro. Yo, like I think that's the first president to have like a transgendered wife, the president of France, which is crazy. I think that's crazy as fuck, bro. Like to like get that allegation is crazy, bro. Holy. All right, so we're gonna get into study. All right, we're gonna get into some studying. I have this little trade going. All right, I don't know where it's gonna go. It might just go up here. It might just go up here. I don't know where it's gonna go. I think it's in Tobias. I'm gonna just let it be. It's only one contract. Hopefully make some of the money back that I've lost, bro. I've been on a losing streak like crazy. I don't know. Maybe it's because I'm not doing the study live stream, so God is punishing me. I guess I don't know, but so yeah, we're gonna continue on month 2. We're on the last video of month 2. To me, this looks like a bearish, a bear flag. So I'm already like cautious that this is just gonna go all the way up. I think we should be up here, in my opinion. In my opinion, we should be up here already. To be honest with you. I thought that's where it was gonna go earlier today, but obviously not. So I'm just gonna leave this up here. I'm just gonna leave that up there because let's see, because like tomorrow's FOMC, so a lot of things could happen overnight. And I'll just keep that there. And then we have 2 sell side liquidities down here. This is Friday's low. This is Tuesday's low. So it could go either way. It could go where it takes out these 2 and gets under the blue and then go up, or overnight it's just gonna run price up here. And then by the time the morning or the afternoon, we're up here. Because I think this is where they want to go short, in my opinion. Yeah, in my opinion, I think that's where they want to go short, honestly. Let's see what's the retracement on the whole entire leg here. That'll be at the quarter. No, it's less than a quarter. Nope, it's past a quarter. So it's like here. All right, so let's see, where can we... Oh, man, they shifted all this, huh? Let me know in the chat if you guys have seen the shift. Sorry about that. Laundry's done. Let's see if you guys have seen the shift. But apparently there's been a shift in the market. So it usually happens during FOMC for some reason. I've noticed that last time that happened was the first great fall during FOMC. Ooh. Don't want to move that. Boop. Okay, so where are we? We are here. This is looking like a consolidation. Okay, boom, boom, boom. 50% is here. All right, now let's start lowering it. And we're going to go right here. Okay. From this high to that low. Okay. Alright, what is this opening right here? What is that opening? That looks like a huge gap. We're gonna get into studying real quick. Let me just fix the chart real quick, bro. I gotta fix the chart. because the whole chart just literally shifted upwards, and I'm just like, well, how the fuck does this happen? Okay, so it's not showing me that far. Bruh, what are we doing here, man? Okay, so that's from a long time ago. I'm just trying to figure out what this gap is. Where is this from? Is it from here? The close and the open. Okay, yeah, it's from here. Okay. That gap is filled. That's fine. Got equal highs up here, which is not cool. Got 40-day low up here. Got a 20-day low here. But this 40-day low is down here. Oh. What is this 60-day low at? What the fuck? Is it here? No. Yes, that is there. Oh god, they fucked this up, man. Yeah, they fucked this up, man. They fucked me up on this. Those are the IPTA data lows, highs and lows. Okay, sorry guys. Ooh, I gotta fix the chart, man. They shifted the fucking chart, bro. They shifted it upwards to make it appear higher. Like the price is here. When price was like right here, like right there, it was like 600-ish. Was it? Yeah, it was 600-ish. So they shifted it up like 150 points. Everything. They shifted everything like 150 points. All right, so we do know that sell side is here. Okay, bunch of liquidities here. Okay, we have a gap, a new week opening gap that has not been filled since last week. I think we're gonna fill this gap. I hope we do. I'm not gonna lie. I need to move all this shit away because this is all wrong. Okay, we have equal highs up here. Delete. Gotta delete most of this shit out of here. Okay. So this is what we're working with. We hit the order block here. That's why we have this. But I think we're going to get up into the order block, into here, and fill this up a little bit. Not all the way, but something. And also we have a regular trading hours gap, as you can tell, right here that was made on Tuesday. And then right here that was made on Monday. So I think that's why we're working our way up here, is to fill up this gap. And probably get in here or somewhere around here. We also have this gap right here. The close and then the open. So this tells me that this gap right here, this open 9:30 opening gap, is filled. So I don't think we're not gonna get in this area. Probably hit the open. We'll probably hit the open just a little bit. Probably take this out, take this high, short-term high out. Probably take this high. But I don't see it going that far. I just see price coming into here. All right, that's where I see price. I see price coming into here and then going short. Because I think buyers are in the market. They're locking in for buys. Especially with this retracement down here. Boom. And then we get in here. I think FOMC would probably get it up there. I'm not gonna lie. This is a 15-minute. This is a 9:30. No, we're gonna fucking change that. All right, that's the first fair value gap of the 9:30 after 9:30. As you can see right here. This is the 9:30 candle. Anything after the 9:30, this one. This one. So I'm gonna see how price reacts to that. As soon as we get into that, we get some special stuffies. Have a good night. All right, price is moving. I like how price is moving right now. This is Asia, so this is 8:30. So we're gonna see what's up. We're gonna see what's up. Bro, I also need to. I need to learn how to use OBS where I can show the chat on the side and I can show the number of viewers on the side. There's a lot of things I gotta learn. A lot of things I gotta learn, man. Fuck. I gotta find time for it. Like my workouts are like 2 hours, but it's whatever, man. I'm very blessed to be like this. Very blessed. All right, so this is Asia. This is the Asia session. And then, yeah, this is the Asia session right here. So we're going to ignore all that. Okay? Ignore all that. Okay? Ignore all to the left. And all we're doing is following this. Okay? Ugh. All right. As you can see, impulse swing. Whoop. Right before the 7 o'clock open. Below the 50. We're 7 o'clock. 7 o'clock right here. Started projecting. Boom. Projection swing. And then boom. Real swing right here. Okay, let's get into the study time because I gotta. While you guys are watching the video, you know what I gotta do? You know what I gotta do, bruv? Alright. I got so many notes to fucking write. I have to catch up. Let me just show you. Oh, let's see. Hold on. Is everything HD? You know what I gotta do, bruv? Alright. I got so many notes to fucking write. I have to catch up. Holy. Let me just show you. Look how HD everything is, man. Bro, if you look at my past videos, this is not... You don't get this quality here. Is everything HD? You know what I gotta do, bruv? That's so cool. That is so cool, bruv. Oh my god. Alright, so what I'm gonna do is leave this chart up here. Okay. While I do my notes. And you guys are gonna fucking... You guys are gonna watch this. This is what you guys are gonna do. Not me. I gotta write some notes. I gotta finish my notes, man. So once we get into month 3, that's where the meat and potatoes start coming in. Oopsie. No. All right. That's where the meat and potatoes are coming in. Is month 3. Okay. While you guys are doing that, I gotta write my notes. All right. Where's my pen? Where the fuck is my pen? Oh, I found my pen. Oopsies. Oopsies. Alright, mate. Ow. Ow. I'm gonna start from...
Okay, folks, welcome back. This is the 8th and final teaching for the 2nd month of the ICT mentorship. This is month October. We're dealing specifically with market maker traps of false breakouts. And we're going to talk about specifically in this teaching one side of the marketplace, just for the sake of saving time. Everything that we show you will be just a reverse of everything that's been shown. So a false breakout above price consolidation. This condition generally manifests in primary bearish markets. In other words, if the market's in a downtrend or if we're presently trading lower or expected to trade lower, a false breakout above the consolidations is reasonably expected and generally what you see manifest itself. At some measure of equilibrium in price, the market will move into a trading range. Neophyte traders or breakout traders will bracket the trading range in price with orders. That means they're going to have buy stops to break out on a buy above the old highs, or sell stops below the old lows to sell short a break below the old lows. In other words, they're trying to capture a trend, and they're going to put a buy order above the marketplace and a sell order below the marketplace because they absolutely have no idea what's going on. Or breakout traders, they just want to bracket the marketplace like long-term trend followers. They don't mind taking a lot of losses with the hopes of eventually catching a large trade. But market makers will typically send price above the range to neutralize buy stops. So they're going to focus primarily on one side of the marketplace. And again, assuming that the market is primarily bearish, that's what the market maker's MO is going to be. Okay, their playbook is to run the buy stops above the marketplace. Now, a false breakout below price consolidations is obviously the opposite. This condition generally manifests itself primarily in bullish markets, and at some measure of equilibrium in price, the market will move into a trading range. Neophyte traders and or breakout traders, again, will bracket the trading range in price with orders, again, looking to focus on buying on a breakout or selling short on a breakout. They're not privy or astute enough to know what direction. They just simply want to react to whatever the market gives them in terms of breaking out above or below. But the market makers will typically send price below the range to neutralize the sell stops. So graphically, what I'll show you here is a breakout trader or a neophyte trader's perspective on a market that goes into a trading range. Above the old high or recent high, they will have buy stops for long breakout traders. And anyone that would be short, obviously, their buy stop would be resting above that high. And below the lows, there would be sell stops for long traders and sell stops for short breakout traders. In other words, they want to capture a move that would hopefully continue going for a long period of time lower. They would like to get short on weakness. And obviously, bulls would like to be, when they're breakout traders, they want to be buying on strength. They think by breaking out above an old high, their buy stop would trip them into a long position, and their belief is that they're going to hopefully capture a long-term trend up. Now, from a market maker's perspective, we look below the marketplace when we have lows in the form of sell stops. Now, I'm going to focus primarily on a buying environment, okay, focusing on when the market is underlyingly bullish. Everything that I show you here would just be reversed for when the market's bearish, okay, just to save time. When the market breaks below the consolidation, those sell stops are used to pair long orders. Now, who's buying those sell stops? It's smart money. But what types of orders rest above here? If we know below the marketplace it's sell stops, what's resting above the highs? Buy stops. So naturally, as the market moves away from those sell stops being ran out below the consolidation, they're going to expand price. Think of IPTA now. They're going to expand price up to the liquidity above the old high. So those buy stops are going to be used to pair long selling. In other words, they're going to scale out their long positions or take some profits. Eventually, the market will go into another area of consolidation or another trading range. The market drops below that trading range to take out the sell stops below the consolidation. Now, as soon as this happens, the thought process should internally be going on inside your mind with, okay, they've already shown a willingness to take the sell stops below 108.55. Now they've rallied price above the 109 big figure. We've retraced a little bit, okay? So if they are taking the market below this short-term consolidation, they're probably going to run the price higher. So where would those objectives be? What's resting above that old high? Buy stops. So if they're taking the market below a consolidation, and our understanding or expectations is the market is bullish, they're taking the market below the consolidations to run sell stops out. The only reason why they're going to want to do that is to absorb those sell stops to be counterparties for their longs. When they are long, when smart money's long, how do they look to exit their positions and book a profit or hedge? They have to get out in a place where there's willing participants to buy. Buyers are always above the highs, either in the form of a buying breakout or buy stops on short positions. That's where the liquidity is. Remember that market paradigm shift that's been spoke about in this mentorship? Well, we're talking about it here again, just using it in terms where you can see how it's applicable in price. Price runs above that old high, and now we have two areas at which the market makers have booked long positions. So now they're pricing in a buy model. So as the market moves higher, okay, they're going to liquidate some of their positions to hedge, and they're also going to liquidate positions that those traders at the bank level are actually speculating for profit. So this is how they actually take their trades and put them on, and how they scale them off, where they're placing their entries and where they're placing their limit orders to get out with a profit. But what's over here? What rests above that? Remember I showed you in the first month of this mentorship in September, specific things to look for. Clean highs and clean lows. Well, there's an area right over here that have clean highs. Above from where we're showing right now, after that 109.15 level has been hit, there really isn't much in way of liquidity voids or pulls that would be of much of interest, except for those stops right above those equal highs. As you can see, price expands. Think now in the interbank price delivery algorithm, it's going to expand up and it's going to seek liquidity. That's what we see here. Then what happens? Price invariably will go back into a consolidation. Now, what's the underlying condition of the marketplace? It's bullish. Why? Because they keep taking price below and then rejecting that, absorbing the sell stops and expanding price higher. Is there any reason to suspect that price could go higher? Look at the price action you see here. You see anything that jumps off at you? If it doesn't, we'll come to it as we move forward in this example. But we have a consolidation in here. Our reasonable expectation would be to see price seek the sell stops below the consolidation. Price does in fact go below the consolidation. What's above this old high? Liquidity. Now, do we always look at the old high, or what do we look for? Do we consider the wicks? We can, but primarily all the volume is seen in what? The wicks or the bodies? The bodies of the candles. So the body of the candles has the most volume, so the liquidity is going to rest above it. So if they took the stops out below the 108.95, they're going to look to run price higher in the form of 109.40 or higher. But initially, we had that short-term consolidation. The buy stops resting above that. They could scale off a position right there. And the next objective would be 109.40. As you can see, 109.40 is swept, moving just above the bodies of the candles. Note the way that the orders are stacking higher each time. When they buy, they're buying a little bit higher each time, and they're working their orders in and still offering opportunities to scale off and profit. So the hedgers can work this model. The speculators at the bank level can work this model, and they're also providing liquidity for those individuals that want sell stops to be activated if the market goes down to those positions. And those individuals that want buy stops above the old highs, they're happy because their liquidity is being provided as well. So think, remember that market efficiency paradigm? You have to think like a market maker. Now we have a larger trading range. Now I've kept that area of which old buying was done at 109.90. I'm sorry, 108.95. But now we've moved into a larger range. Nothing's changed here. The model is still bullish. So we see market action trade below that consolidation. It trades down into 108.85. So with that movement down into that level, where is the liquidity at? Above the old high at 109.45 or so. That's what you have up here. So what is it specifically? Buy stops. So we have willing buyers that are waiting up there for price. Once it gets there, they're buying. Smart money's buying at 108.90 or 108.85 in that area. And they know that there's going to be willing participants to be buying it from them when they want to sell it for a profit at 109.45 to 109.50. So 109.45 to 109.50 is hit. So the buy stops are used to pair long exits. So now look at what we have here. We have a wonderful example of how using consolidations with the expectation of viewing the market with that market efficiency paradigm I spoke about, where we think like a liquidity provider. We can still speculate, we can still hedge, we can still make a profit using the same model. It answers all of the problems as it relates to trading, but specifically it offers the answer to liquidity providing. Buy stops are activated and they're actually given the ability to be effective, and sell stops are the same way. So what the market makers do, we can vilify them. We can say, oh, those rascals, they did this to me, they did that to me. Okay, but what they're doing is their job. They're providing liquidity. The absence or lack of understanding that traders have, they attribute that as those guys, they did it to me. And they usually misappropriate that to their broker. But what it is the market maker is providing liquidity. And if you understand how the market seeks liquidity, that's the number one driver in price action. The market will always seek liquidity. And where is the most recent area of liquidity that's been untapped with the least of resistance getting to it? And that will give you the directional bias when you're a trader. But when you see markets go into consolidation and you have an underlying directional premise, or you arrive at one based on studying the market like this, you can quickly ascertain trade setups and signals will jump off the chart at you by way of looking at it like this. Again, we have to look at price with that market efficiency paradigm. We do not look at it as give me a buy and a sell. Okay, think like the market maker. If you had complete control of price, where would you drive price at to allow other traders to get in and at least facilitate their trades? And at least, whether they're right or wrong, that's not the problem here. Where's the buyers and where's the sellers at? And if we look at the market in this scope, in this perspective, we'll know that we'll always have buyers above old highs and we'll always have sellers below old lows. So if we know that that's where liquidity rests, all we have to do is discern whether or not does the market want to seek the buyers or does it want to seek the sellers? And the way you get that indication is by studying when they go into consolidation, which side of the market they're reaching for, and then where's the market going after it happens. And here you can clearly see every time there's a consolidation, the market seeks the liquidity below the marketplace. And once it absorbs it, it quickly runs the other direction. Why is that happening? Because the market makers are facilitating their long positions and building a buy model in the price or in this asset. So we can expect to see every time the market goes below these consolidations, these movements below it are always going to be viewed in our eyes as a false breakout. So the false breakout that would trip up traders otherwise or knock them out of profitable positions if they would have been remaining long, we can view the marketplace with the market efficiency paradigm, seeing it as a provider of liquidity, see it just in the same scope or perspective as a market maker does, And then we're suddenly in line with the market maker. We're not beating the market maker. We're not trying to outsmart the market maker. All we're trying to do is get in line with what their motive would be. What's their MO? How are they going to book the market for this particular day or for this month or this week? Okay, how are they going to do that? And by looking at the models that we're showing here with looking at ranges, and when they break below the ranges and we see willingnesses to rally after that, it gives you your first telltale clue. Every time the market goes into consolidation, expect every drop down below an old area of consolidation, expect that to be a false breakout, and anticipate accumulation of long positions. And in the market, once they can accumulate their long positions, then they will reprice the market higher, running for the buy stops above old highs. But what else do you see here? I mean, if you're looking at this, what else, if you were to study this for a moment, and I'm going to ask you to pause the video, study this for a few minutes and see if there's anything else that jumps off the chart at you. And don't be discouraged if once I show you what it is, if it wasn't apparent. This first price swing from the first initial false breakout below the old lows and consolidation, once that rallied up, and we gave another area where we can buy again at that 108.75 level, that red area, if you will, I guess it's red, it's a measured move from that same buy, and it gives you an approximation of where the algorithm will reach for to offer price. And we see it reach up into that 109.25 level from 108.75, which is the measured move from the initial low that it ran up and created that first red box in the first impulse price swing. The second leg in price higher is equal to that first one. Also, the larger price swing from that first initial buy all the way up to the intermediate term high or the midpoint of the overall price swing, once we had that larger consolidation and it went down and traded into 108.85, when that happened, that same measured move from 108.50 up to 109.45 or thereabouts, that same measured move from the stop run at 108.85, that gives us a projected run up to that 109.80 level. And you can see that was handsomely hit. And ultimately, that 109.90, as we spoke in real time at the time of this recording in the mentorship, which we spoke about, that 109.90 level being directly linked to the bearish order block on the daily chart. And all these things coalesce. They start to come together. They dovetail beautifully. But understanding each individual component will help us bridge that vast chasm, if you will, of what goes on past the right edge of your chart. You see a lot of times where I'll talk about things and I'll give you scenarios of what I think is going to happen, but specific levels that I think is going to go and be hit. The reason I'm able to do that is because I'm looking at the market just like I'm showing you here. I'm looking at how the market maker is booking, how is the market maker manipulating price, what side of the marketplace are they working on, where are they punishing those that are less informed, okay? And if they're seeking one side of the marketplace over and over and over again, and they keep expanding price away from it, in this case, it's been the sell stops being ran. Every time the sell stops would be ran below a consolidation, it runs higher and it goes to the buy stops. That's the easiest way to see if we're really in a bullish market or a bullish market profile. It's not as easy as everyone says with the textbooks where you draw a trend line, it's sloping up, and just every time it touches the trend line, you buy. No, you got to look at where the orders are going to be residing. And it gets back to that market efficiency paradigm. By having that model in focus, when you look at price and when you see market consolidations, when it breaks below that and you start seeing the market trade higher, every time the market goes in consolidation, they're priming the marketplace to allow sell stops to build up below those consolidations. And obviously what we've shown here was just for a buy side. If everything was reversed and we were seeing consolidations and the market rally up, taking the buy stops out and then quickly running lower and then moving into a new consolidation and then market running higher, running the buy stops and accelerating, going lower again, everything would just reverse itself in terms of everything we've explained here. So I hope this has been insightful to you. I look forward to our third month in the mentorship. So get your notebooks ready because there's going to be a lot more information by way of price action, and we're going to be focusing in on detailed concepts that has been shown in the free mentorship, free members area on my website and on the videos, but all the gaps that I left in that free area of teaching, I'm gonna fill that in as we go forward. So with that, guys, I wish you good luck and good trading.
Okay. I'm just gonna show you examples of what he's talking about. The consolidation, bullish market, or whatever. I'm sorry, that's not whatever, but it's very important for you guys to look at what he is talking about in real time. This is March. This is March 3rd, the first day of March, delivery. This is the monthly, not the monthly. This is the 5 minute chart. So this is your Asia, right? And this is your London. And then after that is your New York, okay? So what he's saying is the consolidation, the break in the market, and then boom. So if I were to highlight this as an entirety, just the bodies of the candles, right? We have this. It's pretty much what he's showing you. Okay? That's pretty much what he's trying to show you. Like, all right, so if we're bullish or bearish, blah blah blah, who are we taking out? And if we're in a bearish market, this is what you would like to see to continue to be bearish, is the consolidation and the break. Okay? That's just one example. Okay, so we can look at for more. We have more right here. As you can see, consolidation. Bro, chill out, bro. Just chill. Alright, so as you can see, we have a consolidation here. More consolidation. Oh my goodness. A lot of long range days here. Alright, so that was just Monday. Right, so that's Monday, and then now we're going into Tuesday. So I like to remind everybody to divide your days up at 12 o'clock, 12 a.m. to 12 a.m. to delineate the highs and lows of the day. See, this is a daily low. So that would be my sell side liquidity. That's my daily low, and that's my daily high up here. As you can tell, right up here, even in the smallest way, this was your consolidation also. It consolidated, all right? Consolidated and gave everyone the glimpse. Oh, we're going higher, and then in the next 5 minutes, boom, we smash. So even in large ranges and small ranges, this happens. Okay. All right. So this is Asia, and then we got London. This is London, right? Okay. Now this is New York, and boom, we hit something here that needed to be hit, which looks like an order block on a higher time frame. On a higher time frame, that was probably an order block. Oh my goodness, what the fuck? Ugh. Yeah, see, it was an order block. That was a 15-minute order block. Okay, so it's a lot of things you have to consider. It's a lot of things you have to consider. Okay, so when you're looking at the charts on a 15-minute, 5-minute, 1 hour, 4 hour, you have to look through it all. And then, like, I like to do top down, so I go from the top all the way down. Make what I want to see be hit, what I want to see, what I've seen, all these things. Um, Same thing happened here. Consolidation. As soon as the consolidation happened, boom, it wants to go down. Right? Did it right here. Boom, went down. Okay. Now we have equal highs up here. Did not want to take that out. Wanted to continue going down. Boom. Did not want to take that out. Boom. You got equal lows down here. But this is current day. This is currently. See this? This is a whole lot of consolidation. If I go on a 4 hour, it's going to be a lot more clear. Alright, to me it looks like it did this. The bodies of the candles have been taken here. So this tells me, and then as soon as it takes it, boom, we get this swing here. All right, so I think we're gonna start taking highs. I think so. Not too sure. Probably up to here. If anything, it's probably up to here. I don't know. I'm not gonna lie to you, but I don't think we're done going down. I don't think we're done. I don't think so. Look at that. They freaking moved everything. Oh my god. You can see the distance that they hit. 104. And it used to be at, like, bro, that's fucking like 500 points, nigga. Oh my god. Crazy. Look at that, bro. What is this? 540, let's say 550 to 700. Oh my god. 200 points. 200 point movement. That's crazy. That's fucking crazy work. So it happens. It happened here. Happened here. Happens everywhere, man. Really does. Do I think we're done going down? Probably. I think so. We have equal lows here. We have this order block here. Let's look at the monthly. It looks like we hit this monthly order block. It looks like it. I'm not too sure. It's the first time. I don't know if it's fucking, if that's how it works. But on the 4 hour, this looks like it's done. But I don't know, man. I'm gonna be honest with you, I don't know. We're all learning, man. We're all fucking learning. So yeah, those are the examples of a bearish, it going down bearishly. Consolidate, take a high, then go down, or bullishly, take the low, then go high. It's all about turtle soups, honestly. Like, this operates off of turtle soups, is what I've noticed. Like, a lot of turtle soups. It likes to take the high and then reverse. It likes to take a low and then reverse. Sometimes it doesn't even do that. Like here, look, it doesn't even take out the high. It just goes, boom. That's it. We're done. And then boom. And then boom. That's it. Boom. That's it. Boom. That's it. No more. But here, this looks like it wants to change direction. Just off the impulse swing. But on the 4 hour, it looks like it's done. You know? On the 4 hour, it looks like it's done. This is just a rejection block. Yeah. 4 hour, it looks like it's done. Like, we're just going up for the rest of the time. I think we've shift bullishly. We took out a higher here. Boom, 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 boom. Retracement. Boom, 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 boom. So I think we're going for buys now. I think the market shifted to buys. I think so. Okay. not quote me. I think the market shifted to buys. Yeah, this is looking like buys. Just off of experience, like how price gets delivered. This is now I'm looking at it a little bit differently after watching that video. Yeah, this is how the market operates. Price has been delivered here. Because I'm looking at the bodies of the candles, I'm not looking at the wick. Sometimes I have to look at the wick too. Man, this is confusing. They really fucked it up with the wicks, didn't they? Oh shit, dude. This is fucked. This is fucked, man. Look at this. Yep, this looks like a false. Looks like a false bear flag. That's why I put a buy. I'm like, oh, this is a false bear flag, bro. There's nothing else you can tell me. But those are the examples. If we're bearish, we're bearish. We got equal highs up here. Got some highs up here. Got some highs over here. I don't know. I kind of want more sells. I'm not gonna lie. Not gonna lie, dog. Ooh. Not gonna lie, dog. Not gonna lie, dog. Fuck. More shells. More shells. More shells. Hopefully we get more shells. All right, continue. Enough of my bullshit. All right, I don't know how to trade. What are you talking about?
Okay, folks, welcome back. This is the first of 8 teachings in the 3rd month of the ICT mentorship. And this topic is going to be specifically dealing with the time frame selection and defining setups for your model. Okay, for time frame selection, there's a couple things that we break down in general ideas and terms. For the monthly chart, we use this for position trading. And for folks that are intraday intolerant, that means you can't do anything in lower time frames. The monthly chart is actually going to do a lot of assistance for your trading and your analysis. So don't be discouraged by the fact that I do a lot of intraday work and short-term trading. You'll be shocked to learn as we go through this mentorship. The precision and the accuracy that I have has a lot to do with the direction that's derived by the information on the monthly chart. But as it is, the monthly charts are the basis, if you will, for our long-term position trading. Now, I can admit to you, like I've done many times in the past, I am not a long-term trader. I don't have the personality to hold on to a position that long. I tend to change my mind a lot, and that doesn't fit well for a long-term position trader. So if you're a person that takes a long time to make a decision, it comes hell or high water, you're sticking with it, that's probably the avenue that would best suit you as a trader. Now, I can't determine that. No one can do that but you, and that's going to come by way of you actually doing trades. If you get real scared, or if you get real hyper about the short-term nature of trading, if you trade on these longer-term charts, or at least trade off of the ideas that come from the monthly charts, it removes a lot of the price action shock that comes with intraday trading or short-term trading. The weekly chart we use that for swing trading. Now, swing trading is a little bit more frequent than long-term position trading. Swing trading is, by my definition, it's typically a 1 or 2 trades within a 3-month period. So every quarter of the year, in other words, every 3 to 4 months, there's going to be a setup that takes place. And you can find them very easily on a weekly chart. Because the weekly chart is much like the monthly in regards to how long it takes to form the setups, it takes a great deal of patience. And while I am attributed to having a lot of patience, it's not that great of in other words, the well doesn't go that deep. I don't have that much of patience. So the weekly chart, again, while I may not be trading specifically on the setup itself, I will use those ideas to help frame the short-term trades that I take, or even the day trades. But for swing trading, again, for those individuals that can't be in the marketplace on a very intraday, minute-by-minute basis, again, the weekly chart will actually serve you very well. You don't have to do a whole lot of trading. It's a whole lot of time in between the setups, and much like the monthly chart, it removes that initial shock of short-term volatility. Now the daily chart, that's where we do our short-term trading. The daily chart, to me personally, I believe this chart is the best chart there is, because it gives you the best of both worlds. It gives you a long-term perspective. It gives you all of the near-term banking levels. So all the levels that the banks would be interested in, all the large funds would be interested in, you can clearly see those on this daily chart. The daily chart also gives us the framework to do a lot of analysis for short-term trading. So it has the benefits of higher time frame, but not to the degree of weekly and monthly, but it does give you a higher time frame perspective. So if we can arrive at strong analysis reference points in terms of institutional order flow, if we can look at points at which there may be stops, there may be a liquidity void, there may be a fair value gap, these ideas, much like we said in the first month of this mentorship, what things you should be specifically focusing on, those ideas, if you apply that to the daily chart, you'll have a plethora of setups and plenty of things to trade on. Now, you can trade on the daily chart, again, if you are the type of trader that hasn't the opportunity to trade in front of the charts, be in the intraday price action, or again, if you're not comfortable trading in those lower time frames, the daily chart does a very good job of suiting swing traders and short-term traders. So that, to me, is the reason why I like the daily chart the best. If there was a chart selection, I had someone hold a gun to my head, which chart would I like to trade off of? It would be the daily chart, because it gives you a great deal of range to work within. It gives you the interbank levels to be monitoring, where stops would be residing, where long-term objectives would be seen in form of liquidity above or below the marketplace. And again, I counsel you that can't be in the day trading models that we use to try to at least try your analysis on the daily charts. Just, try to work on those specific time frames. And if you still feel very sensitive or scared, or if you have a lot of emotional or influence over your emotions by watching price on the daily chart seems a little still too fast for you, move up to the weekly chart. Okay, there's nothing wrong with doing that. It just takes a lot more time. And unfortunately, some of you that are listening, you may have a business, and you may have a lot of things going on in life. Maybe you're a college student. Okay, maybe you can't be in front of the price action on an intraday basis. When we trade these higher time frames, you're going to see that there's a lot of movement available, but you're going to have to submit to a lot of time too. And obviously, 4 hours or less is day trading. And we're not going to speak too much about day trading in this particular teaching, because there's a lot of things that we got to go in regards to day trading, and there's specific concepts that are inherently related to time of day. So while we're not going to teach that here, the focus is time frame selection, and what time frame are we using these specific time frames for. Now, defining setups for your model. Now, it's important as a mentor, I don't try to force you into a specific mold. It's never been my goal to give you a copy me, be just like ICT. That's not going to work. It's never going to work for anyone, but it does give you a goal. It gives you a framework to work within while striving for replication of some of the things you probably see me do. You're going to discover the trader that actually resides in you. And when that happens, and no one knows when that's going to occur, you'll know it by experience, being in the marketplace, looking for specific things and studying. And one day, and it sounds like, a fairy tale, but it really is, you'll have an epiphany where all of these things will suddenly make sense to you, and you'll know what type of trader you want to be. And what's even better is you actually know what setups that you'll like. It's one thing for me to say I like a 4-hour turtle soup sell into a bearish order block that's seen on the daily chart. Well, that might be a setup that you can't wait for. Okay, it may require you a lot more patience than you have to do that. That same setup, if it was done on, say, for instance, a weekly turtle soup sell into a monthly bearish order block, I can't wait for that. I would never have any trading opportunities because they don't happen that often. But if it just happens to be the time when you look at the charts and you see that formation, then obviously that's your setup. But your pattern or your bread and butter go-to setup, once you understand it, it's applicable on all these time frames. What makes the time frame selection process unique and why it's important for you as the trader, to determine how you're going to trade it, is because your comfort level and your psychological makeup as a trader has to align with that. So in other words, your patience level, your aptitude, and your life. I mean, let's just be real about it. Your life has to allow you the ability to be in front of the charts, or at least to do the analysis and then execute on that analysis. So when we look for setups, we have to find setups that are uniquely defined for your specific trading model. And a lot of folks will say, ICT, you got a lot of tools, you got a lot of things that, you have a ton of things. Okay, do we have to know all these things? No, that's the benefit of studying conceptually and modular things, because you'll quickly ascertain whether or not a specific pattern or concept gels with you. In other words, does it resonate with you as a trader? You're going to find that some of the systems and things out there in analysis aren't really uniquely attractive to you as a trader. And I experienced that as a trader coming up. It wasn't a lot of things out there that I got excited about, but the few things that I did in early in my days, it was commitment of traders report, accumulation distribution, things of relating to patterns. I liked the patterns because I wanted to see specific things that repeat, because obviously, like anything else, if you can see something coming, obviously you know what to do should you see an opportunity coming. The problem is many of the things I was studying, I couldn't find them real time or before they actually came to fruition. So as I refined my trading model and specifically dealt with institutional order flow, and price action, then suddenly it was like the veil was lifted and I had blinders removed from my eyes. Then I could see setups that made very specific formations, and they had specific criteria that I can really define and make it very objective about how I trade, which is what I was looking for as a trader when I first started. But when I first started, I was looking at indicators thinking that was going to be the answer. And you probably, if you're listening, you probably have had that same feeling. Like you want to feel informed, you want to feel like you know what you're looking for, but because you don't, and it's normal for you not to know what that is when you first start trading, even for some that waffle for the first couple of years and they still can't find the rhythm, they will sometimes look to an indicator to give them a reason to do something, and because they need to be told something outside of their own ability to decide. And sometimes you'll see that the indicator will lead you to a setup, but then most of the time it really doesn't. And it's because most of your trades are linked to a mathematically derived indicator. when we look at setups, we're looking at specifically finding unique characteristics that repeat themselves over and over again in price action, because there are generic characteristics and traits in price action that repeat over and over again. They're not limited to any one of these specific time frames. So when we look for specific setups, we're going to find a setup that we individually as a trader like the most, the one that we can see easily. And you're going to see that while some of them overlap, some of them won't overlap, but they still will give you an opportunity to be in the marketplace in the right direction. So a trend trader, that's one model that a trader can be using all my concepts with. You're going to be trading only in the direction of the monthly and weekly charts. So in other words, if the monthly and weekly are indicating it's going to be a bearish marketplace, you're going to only be trading short and holding on to these positions for a great deal of time. If it's bullish on the monthly and the weekly chart, obviously you're going to look for buy signals and you're going to hold them for a great deal of time. That is the nature of trend trading. And again, I am not a long-term position trader, so while I tried that early on in my career, it didn't fit me and it didn't tickle my fancy, so I'm a short-term trader. Now, swing trader, which I've done a lot in my early days, but because I found that it was more of an allure for me to be in the marketplace more than just a couple times a month, a swing trader, they're trading the daily intermediate term price action. And you're going to see there's a lot of setups that require you to sit on your hands and wait. But when they form and you position yourself in them, they offer stellar rewards. I mean, they just go on and on and on, and the payouts are amazing. But again, it requires a great deal of patience. So I can tell you, as your mentor, I just don't have a lot of patience for swing trading on the daily chart. It just takes too much time to wait for the setups and for the trades to pan out. I want my money to have velocity. In other words, I want to be able to put my money at work, let it do its thing, get my return, and then compound that returned rate and my base equity and put it back to work again into something that gives me more velocity. So when I say these things, I'm not trying to talk to those individuals that are comfortable trading on a monthly chart or a weekly chart. I'm trying to tell you that me personally, what I found about myself as a trader, my defined setups are on a lower time frame than the daily chart. So it requires a little bit more dynamic study and time in front of the charts, but that's what my unique model is. I excel in that approach to trading. You again may not be set up psychologically or emotionally prepared to trade like that, and there's nothing wrong with that. So don't think that I'm trying to force you into a specific trading model or a mode of trading. You're going to discover that as we go through these 12 months. Also, you're going to learn, this is how I started, as a contrarian trader. Okay, now it doesn't always mean that being contrarian is the right way to go about it, and it doesn't mean that not being a contrarian is the right way always as well. There's going to be times when to be a contrarian trader is optimal, and what you're basically doing is you're trading reversal patterns at market extremes. So when the market's really gone a great distance higher and it's been moving higher for a long period of time, eventually it's going to hit a specific level, or a significant level, I should say. Usually and typically it's on a higher time frame. It will create reversal patterns. Now, it doesn't mean that the market's going to reverse and create a top there. It can, and sometimes it will, but you can still trade reversal patterns at extreme moves, or what would be referred to as capitulation, where the market just moves extremely, that last bit of burst higher if it's been bullish, or that quick sudden drop, with a great deal of magnitude going lower, and it usually makes the low of the move. Generally, sometimes you're going to see that there will be times where you want to be a contrarian and see that move as a blow-off move, and it's the end of the move, and you can probably catch some really good setups in the form of a reversal pattern. But it doesn't always have to require capitulation. It could be on a short-term basis, where if you watch the daily chart, we may go above a previous month's high, and that may be a really good selling scenario to sell short, but not forever, but it's still an opportunity to trade with. And then for short-term trading, which again, that's what I excel in, you're trading the weekly ranges, and you're holding for typically about 1 to 5 days in duration. And then obviously setups that are found for the day traders model, where you're trading intraday swing trading with exits by 2 p.m. New York time. And when we look at this, this is the actual broad brush idea of everything that I do as a trader, everything I've done as a trader, how I excelled from using long-term higher time frame charts down to what we're seeing here in number 5 and number 4 in respective terms of time frame selection, 4 hour or less. That's where I excel at. And then my setups are day trading in nature. Now, again, because I have a universal application and I have experience doing all these types of trading, just because I don't elect to trade on a monthly or weekly or daily all the time, what I'm actually telling you is I can do that, but because of my appetite for more action and because I want to put my money at work faster, get a rate of return, and then put it back to work again, so I can turn it and capitalize on velocity, turning my money over and over and over again quicker. I have adopted the mindset that that's my goal, that's my pursuit. So therefore, to do that more efficiently and expediently, it's going to be in the form of day trading or short-term trading. Do not let me convince you or try to talk you into that's the best way to go, because it's not. It's not for everyone. So you can still compound your money exceedingly well trading on a higher time frame charts. Believe me, it's not about the setups or the time frame. It's about your unique alignment with the setups and the time frame that meets the happy medium for you as a trader. Because all of us have a family, all of us have real world tug of wars that take place. Some of us have spouses that require a lot of our time. Some of us are in high maintenance relationships. Some of us are in codependent relationships. Some of you are not in a relationship. Okay. Some of you are doing things that are going to be a barrier to you doing a lot of trading or a lot of studying, and it's going to require you to do a lot more research and action in those higher time frame monthly and weekly charts and daily. But if I were to counsel you and you were going to listen to me, I would suggest that you start in the daily chart. Even if you're going to know in your heart of hearts that you're going to try to be a day trader, start with the daily chart, because the daily chart is going to be a really good bellwether. It's just the one that will give you everything you need to know with a lot of the higher time frame reference points, and it'll also give you the directional bias that everybody looks for, and they're always asking by way of email. Tell me how to get in, where to buy, and how do I know the day's going to be up or down? Well, you find that on the daily chart. That tells you everything there. And once you go through this teaching and the next teaching with institutional order flow, you'll see how easy the daily bias is. Really, it's not that hard. But the problem is trusting it. That's the hard part. All right, so let's take a look at a monthly chart, okay? And the monthly chart, its premise or its influence in your analysis is it's the long-term price action reference for the largest price action swings in trading. Now, trading setups that take a great deal of time like this, they form in a time frame that most people can't bring themselves to trade. But when they unfold, these setups that you see in the monthly chart, they tend to unfold over a period of many months. They don't just happen like little blips on a 5-minute or 1-minute chart. They just go on and on and on. Now, due to the length of time this chart requires to present a setup, trading in the direction of the most recent setup can yield the lowest risk with the highest reward conditions. Now, what I mean by that is when you have the directional bias or trend, I'll say it with quotation marks, if you can see where the market's going to most likely go on a monthly chart, you have a great deal of advantage by trading in that direction. Even if you don't catch the actual move that creates the optimal entry for a sell or a buy, because it's a monthly chart, the very nature of its time frame, it gives us a great deal of time to still capture moves in that same directional bias or in that trend direction. Now, swings that form on the monthly chart, obviously they can be several hundreds of pips, and it's going to require a long period of time to unfold. But let's take a look at a sample with quotation marks, a long period of time to unfold. But let's take a look at a sample size of price action on a monthly chart here. Now, obviously, we just turn our charts on. We look at, and this is what's recently happened here. And all of a sudden, the very next month, we see that. Okay, we weren't watching price closely. This particular market was unclear to us at the time. But right away, now we know that there's somebody in the marketplace moving price around. Okay, go back to the very first teaching in this mentorship where I tell you to look for markets that want to show a strong willingness to move away from a particular level. Now, prior to that down move, we saw price in a small little consolidation, about 600 pips or so in range, and then finally the market broke down on a monthly basis. So each one of these candles represents a month's worth of data. And eventually the market takes a greater deal of magnitude lower. It surges lower. And again, take a look at how many pips this would be. And obviously, this is the Euro USD. The move from 59.50, we'll call it, all the way down to, let's just say 24.50. Okay, that's a lot of pips. A lot of pips. Now, when you see this, it's rather shocking when you view it in terms of how many pips are available. And it takes you 3 months to cover that much distance, or a little bit, well, 4 months to cover it, really. So in 4 months, the euro dollar trades a couple thousand pips. Okay. Now, again, each one of these ranges are specifically a monthly range. In other words, the highest part of that candle for each individual candle is the high it traded to the most for that particular month. And the low of the candle is the lowest it traded for that month. The opening is where the month started trading, and then the close is the last trading day of the month where it closed. In these individual monthly candles, there are a plethora of setups. Think about what you have there. You roughly have about 20 trading days without holidays included, things of that nature, and non-farm payroll, which we don't trade. But we'll just say roughly it's about 20 trading days per one of these candles. So every one of these bars represents 20 potential trading days. Now, inside of those daily candles, okay, if we were to break them down, okay, there are individual setups as well. Now, also, and I skipped over this, inside of these candles of representation of monthly data, there are typically about 4 weekly candles. And again, inside the weekly candle, there's a great deal of opportunities in there. So I want you to think like that. When we look at a seed, okay, if I were to show you a seed, say for instance a apple seed, I placed an apple seed inside your palm, and I asked you what you see. Obviously, most of you would have a very myopic view and say, well, obviously it's an apple seed. I know it, I've seen it before. But I want you to have that view where you see the apple seed, yes, but you see the potential of that apple seed and how many trees that one seed could produce over time. And with the creation of all these new trees, the obvious is that you'll have more apples. So when we look at these higher time frames, we look at as that's that seed, okay? That really high probability trade scenario exists in the monthly chart. Now, most of you don't want to spend time in a monthly chart. Most of you could care less about what that monthly chart says or what it's done, because there's no magic in the monthly chart, because it takes what? A whole month to create. The problem is that's the wrong perspective. You need to look at the monthly chart and say, hey, you know what? If the monthly chart's moving around, okay, and the monthly chart's having sensitivity at specific levels, who would be moving price around on these levels? And obviously the answer would be large banks and institutions. So if we have that mindset, we can go into the monthly chart with a great deal more of appreciation, saying, okay, well, I know that the market's going to be driven by deep pockets. If it's going to push price around on the monthly chart, there's a great deal of deep pockets, smart money, banks, institutions. They're all going to be in here pushing price around. So it's in your best interest to understand what that monthly chart's going to do and what it has already done. In this case, let's just say we opened up our chart and we saw the euro dollar here, and this is what we see. So right away, without having any other forms of reference. Okay, we don't need anything like that. And this is how I'm trying to tell you, understanding price action. It's very pure. I don't need to know where trend is prior to this sample size and data. I don't need to know what indicators are indicating bullishness or bearishness. I don't need to know that either. I don't need to know what crossing overs of any moving averages took place. I just need to know where has price moved away from, and was it with a great deal of magnitude? Yes, obviously we moved away very strongly from a consolidation around the 51 or 52 level up to the 59.50 level. Okay, so we had about moved away from 700 pip range or so. And when we see this, the way I want you to view prices, your eyes goes immediately to that last up candle, because we understand that smart money is going to sell in up moves. They sold in that up candle, kept it in a range, and then finally it broke down below that up candle's low. So now the point is, yes, you've missed that boat. The opportunity's missed. You couldn't sell short there, because we're going to assume that we're now just looking at the chart for the first time. You as a trader can say, okay, I know that if it gets back up to that candle's low, and again, this is a monthly chart, I'm going to have a trade, and I'm going to define that trade by way of that specific up candle's low. So eventually when price does that, we have many months before it actually does it. Over a year transpires. Now think about this now. Over a year transpires before price returns back to that up candle's low or that bearish order block. But as soon as it hits it, then you have a setup. Now the question is when price hits that, okay, it takes a long time to get to that particular level. But as price was trading around that 127.30 level, and eventually it trades through the 130.50 level, up through the 132 level, okay, we have an indication that the price is probably going to want to go back up. And there are stops, obviously, around that 146 level with that big up candle right here. This big up candle right in here. So there's going to be stops resting above that high. Again, thinking about that concept that I gave you, what to focus on now in the September content of this mentorship. So we have this candle breaking above this down candle, this bullish candle here. All of a sudden now, we have a willingness to do what? We expect to see price try to trade back down into this down candle. And it does it here. So we can expect to see bullishness here. So if we see this, we know that there may be some bullishness on the upside, okay? And price may reach up above to take these stops. And if it does that, it may reach back up here to this bearish order block. So when it finally gets back up to that bearish order block, we've had two instances where we can see where price has, on a monthly chart, broke down, traded all the way down here. We can see the bearish candle here that was violated on the upside, and then it returns back into that down candle. So we can see bullishness in the form of a bullish order block. In that case, we can see that price has a willingness to potentially range expand up into that return of that bearish order block right over here. But when it does hit this, when it finally hits that particular level there, the question is where would price likely trade to next? On the monthly chart, again, this is no different than what you see me do on a 15-minute chart, an hourly chart, or even a daily chart. But where would you reasonably expect to see price trade from once it trades at this level here? Well, what's under there? We got basically equal lows, but look at the bodies of the candles also. It's too clean, way too clean. Now, again, think, this is a monthly chart, folks, monthly. If we are looking at this right now for the first time and we sit in front of our chart and say, okay, I see this level being hit, what could we do with this? Obviously, we can expect to see price trading lower. But why? Why lower? Below those lows is going to be what? Sell stops. Now the question is this. Who in their right mind would have sell stops below that low? And the answer to your question is large funds. Large funds. Long-term trend following funds will have stop loss orders right below that low. They will leave stops in for a very, very long time, and they have lots of money in play. So when the market trades at that basically that 50-80 level, and it goes lower and expands lower, it's rushing down to get to those stops that are residing below the 122 level. And look at that last candle before it blows out the lows here. All these lows in here, that last candle, when it hits it, look what it does. It explodes to run out those particular stops. Now again, I want to remind you that this is a monthly chart. So if we see this and we can outline where the market may reach up into, which took a trade duration of 6 months to unfold, but it took over 13 months to set up. It took 13 months for this, basically the trade up, to get back to an area where we would see a setup to form on the monthly chart. But then once the formation comes into fruition, look how many months it takes to unfold. You got 1, 2, 3, 4, 5, 6 candles, or 6 months. Look how much acceleration there is. It's half the time. Half the time it took for this chart to unfold and set up the setup, and then half the time, or basically 6 months, to get down to these stops. In this setup, okay, I'm going to ask you a question. What type of trader are you? When price was hitting that 50.75 to 50.80 level or thereabouts, what type of trader would you be there? When price is most likely going to come down and clear out those stops, you have several opportunities to choose from. You can be a possession trader and be short around that 150.80 level, 151, and look for a move all the way down to the 122s. Now think about that. That's an enormous amount of time and potential range. Could you take that trade? Do you have the wherewithal to hold on to it? Personally, I couldn't hold that long. But does that mean I can't trade this idea or these perspectives on the euro dollar? If I can see 51 big figure, it's 151, or the return back to that bearish order block, as we're noting here at that orange level. When price is trading there, it spent two months giving you an opportunity to get on board. If you see that, and the reasonable expectation would be, okay, well, there's some equal lows down there. It's probably going to take a long time to do it. But between the 151 level that we'll say and the 122 level, there's our range. So between those two reference points, we have a known range to work within. Now, again, this is a monthly chart. Before all these down candles form, we have the potential range identified. So we can now break this down and say, okay, I already know where price may likely go relative to the monthly chart. So how can we use this information going forward and go across all the spectrum of types of trading? Again, it's over 2,900 pips for that price swing. 2,900 plus pips. So let's take a look at this swing on a weekly chart and refine that more in terms of defining setups for your trading model. There's that same price swing, and we're now looking at it on a weekly chart. Now, this is an intermediate term price action reference point. So everything we see here is on the scale of intermediate term. So obviously, because it's a weekly chart, it still takes a great deal of time for these things to set up, but it's a lot more refined when we break it down into a weekly chart. You can see a lot more detail. We can see, obviously, when the market trades back up into previous institutional reference points, like this down candle right before the move up, this down candle is a breaker. What's it breaking? It's breaking the old high here, running out stops. This breaker is lower than this one here, so we're going to have to refer to that one here as the initial run up. Trades up into this range right there. There's a selling opportunity. We already know that the range is potentially going to expand to run out based on the monthly chart, that this is where the liquidity is going to be. What kind of liquidity? Large fund liquidity. So the market expands, goes lower. Then it consolidates again. It trades lower and comes right back up into what? A bearish order block. So you can expect to see what? Another opportunity to sell off. Why? Because you're trading in the direction of the monthly chart. But now you're expecting the weekly chart to expand. And it's going to most likely expand down into this level where liquidity would be resting. We could take this one step further and refine it down into a daily chart. Now, obviously, the daily chart is going to be a short-term action-based time frame where you can see all of the intermediate and you can see the short-term highs and lows in the marketplace. But more specifically, you can see how you can actually frame your short-term trades and your day trades. Now, again, we're not going to talk about day trading for this model here, but for short-term trading, we're going to look at specifics that deal with that. We know that the range is defined from a known high and a known low. The high is where that bearish order block was on the monthly chart. The low at which we're aiming for was those lows on the monthly chart where they were equal lows. So we know the stops that were resting below that. So if we know that, we can take our fib and lay it across those two reference points. And by doing so, we end up doing what? We start grading that price swing. So these levels that we have here, these horizontal lines, they're areas at which the market should see new setups form. Now, here's the thing. We knew the range before it actually traded. So we can anticipate new trading scenarios or ideas to form in our charts when price trades at this particular level. And setups will form in close proximity to these levels as well. So every time we see, this is the first quarter lower from the high down to the low. So this is 25% of that range. We see a setup in here, okay? The market trades lower. We go into equilibrium. The market does what? It trades lower, comes right back to equilibrium, and expands again. Comes back one more time, returns into the range, sells off again. The market sells off, comes back up, fills in a void, sells off again one more time, and closes, hits the terminus of the move. Now think, all these things that we've been teaching so far, they're repeating themselves, but the thing is, this was all outlined on a monthly chart. But the trading ideas are refined further by breaking down the monthly chart into a weekly chart, and then weekly chart breaking that down into a daily chart. Now, as a pattern trader or a setup seeking trader, like you all are, there's several things that we do in the ICT camp. We look for optimal trade entries, which is a simple return back into a known range. And that's the only indicator-based ideas I like to use, and it's based on fib and returning into a known open range. The other ones are obviously order blocks, and then there's stop runs, which we classically call the turtle soup, which is a false breakout, which is what you're seeing here. Every instance we see on this chart, we have a short-term high here. Now think, inside this shaded area, the monthly chart, we used it to frame what? The idea that we're going to go long-term lower. As we are in this shaded area until it ultimately hits the 2175 level or so, we're going to be bearish on the marketplace. So we look for what? The marketplace on the daily chart to seek liquidity above old highs. Why would they want to do that? The market's traded lower, this short-term high, relatively equal to this one here. There's going to be buy stops resting above that short-term high. They run above it and then explodes lower. Okay? We have a short-term high here. The market trades above it and then explodes lower. I want you to notice every single time that the market takes out a short-term high just by a little bit and then quickly accelerates on the downside. Why is that taking place? Because they're absorbing liquidity on the buy side. They want to pair up their orders to sell into those known participants that want to buy here with their trailed stop loss in the form of a buy stop. Because think about it, if you're short, how do you protect your position? You put a buy stop above a recent high. And then typically what will happen is the market will come back and knock you out and you'll start cussing, or the market will move away in your favor, and then you can look for another point at which you want to lower that stop loss, protecting and locking in profit. Well, what we do is we look for these opportunities in the form of false breaks above an old high with the idea on a higher time frame chart that indicates that price may go lower. So this is like a holy grail setup where it's absolutely barn burner. You get in there and you look for a short-term high to be violated on the daily chart. Look how many times it does it in the scope of all these many days. But look at the logical areas at which it does it. It's close to those grades that we did on the overall total price swing that we expect to see. It does it here. We have it here. We have it here. We don't see it in here, but if we go down to a lower time frame, you will see it. And then we see another one in here as well. So when we look at price, okay, if you are looking to trade only stop runs, okay, you first have to know why the stop run would be necessary or why it would be influential in terms of price action. And you get that from the higher time frame like we showed with the monthly chart. You hold on to that bias until clearly you're shown that you're wrong. In other words, this thing could easily turn around here and start trading all the way up and start getting violently bullish. And that would have to obviously make you change gears, or at least put pause on the notion you expect to see the euro dollar to trade lower. But until it does that, or it hits the terminus, or whether we ultimately think the price is going to go, we stay with that mindset. We stick with it. So if you're not a stop run setup trader, in other words, you can't see turtle soups, if you don't have the ability to trust that, or know that what you're selling into, okay, is a high probability scenario where it's going to see an explosion in the higher time frame direction, in this case down, there's other things you can trade. And they come in way of breakers and bearish order blocks. Now, obviously, the whole move starts back here with that monthly bearish order block that it trades up into. But look what it does. It comes in the formation of a turtle soup, or a false break, or a run above equal highs, taking out the buy stops. And then what happens? The market surges quickly. Okay. And then we had that previous turtle soup here. But now look, say you can't see the turtle soup. No problem. There's absolutely no problem. This down candle in here, right before the move up above this short-term high, that down candle is a breaker, and you'll learn about that in this mentorship. But as price is trading in here and trades back up into the breaker, you can now expect to see price to trade lower, and it does that. We have another breaker in here, down candle right before the up move that takes out a previous high. So you can't see the turtle soup here, no problem. See it in hindsight. The market's already moved down here. When trades back up into that breaker, you can go short. Well, what about if you are an optimal trade entry trader? You pull the fib from this high down to this low, you'll get a 79% trade lower here. Optimal trade entry, get short. Okay, then you have another breaker here. You have a down candle right before this move above this short-term high. Okay, when price trades back up to it here, you get short at that breaker. Sell off, boom. What about this one here? This is a bearish order block. Last up candle right before this down move. Returns to that level, sell it short. And there it is. What you're doing is you're using the higher time frame and you're using your defined setup for your model. If you're a trader that's focusing on being short, you need to identify what pattern you're going to be looking for. It could be one or two, but it's important to know one. You only need one good pattern. And I only have really technically three. I trade inside of a range, okay, where I'm pulling back into an exposed range, okay, or if it's bullish and it rallies up, I'm waiting for it to pull back to close in that range, and then I'm going to buy it again. Or I'm selling at a bearish order block, or I'm selling short into a run above a previous high for sell stops. Now, I'm only taking three setups. There's only really three setups that I trade. I'm trading inside the range. If there's nothing that I can see as a violation above an old high or below old low, I'm selling above a previous high if I'm bearish, or I'm selling at a previous bearish order block if I don't believe that it's necessary to go up for those stops. And you'll learn when those conditions are there, because I know what you're thinking. That's the thing I need to know, ICT. That's the one. Because if it's me trading back to a bearish order block, but it could potentially be a turtle soup, how do I know which one? You're going to learn that. But I got to give it to you in pieces at a time. So again, when we look at the market like this, and we have our time frame selection, and then we have our setups for our particular trading model, and that model is going to be defined by you over time. No one's going to be able to tell you this is how you do it. Okay, I'm giving you suggestions, and the three setups that I particularly trade, you're going to be able to gravitate to one of them, and it may be order blocks. But for some of you, the order block is going to be problematic. It's going to be, I don't know which one to trust. but you'll clearly see where the stop runs are, and you'll be able to trade turtle soups. But maybe you can't do that either. Well, you'll trade in liquidity voids. Okay, you'll wait for the price to come back down, close in a range, and then you'll wait for expansion to happen. But the point is, these three forms of discipline that I use for trading, they always exist in all time frames. And it doesn't matter if you like order blocks and your best friend that you're trading, studying with and you're comparing notes with, which you really shouldn't be doing, by the way, as I say that in this mentorship. But if you're seeing other people talk about their ability to do certain things and you feel frustrated that they are excelling in an understanding of order blocks and you are struggling, but you can see the turtle soup run on stops, that's your pattern. Don't force it. Don't try to, just because order blocks or somebody's showing a lot of trades because they can see the order block, there's no preference over this. It's whatever I see at the time when I turn the charts on. And if there's a void and it comes back into that void, I know what I'm going to do. I'm going to look for that run to try to run that previous high. If we rallied up and we created a liquidity void on the upside, when that trades back down into that range, I'm going to buy it with an expectation it's going to make a new high. And that's the only setup I'm looking for. I'm not looking for 5,000 pips. I'm just looking for that known range. And you'll learn all that. But don't think that I'm forcing anyone to be any one particular trader, but you will learn these three conditions in the marketplace because that's the only three I trade with today. I don't do anything outside of that. I don't trade ORO patterns. I don't trade, all the things that I shared in the past. They were all hallmarks of my, coming up as a trader. But I don't do all those things today. I only trade these three things, and I don't need anything more. In fact, I could just reduce it to one. But because I like a lot of action, I will look for these three things every single day across the charts, and I'll find a setup. And I've shown it to you. I've proven to you on a daily basis. When you understand these three characteristics in price action, nothing evades you. Not a reversal, not a trend following pullback, and not a expansion out of a consolidation. Nothing will evade you. You'll have everything you need to know in a repertoire, in a toolbox to trade any market profile. So with that, I'm going to wish you good luck and good trading.
Okay, this is what he's showing you on a daily chart, on a monthly, weekly, daily. This is where he's trying to show you, hey, if you wait for this, you can make this much. So if you're a position trader, this is what I'm looking at personally as a position trader, swing trader. I'm looking at this order block. I'm looking at this. Okay. My right ear, so I might be right. I'm looking at this. Okay. And I'm also looking at this too, but mostly just these two. Okay. So there's a chance that it might go lower, but there's not a chance that it might not, But currently that's what I'm looking at. So what he's trying to show you is that these things, it's better to trade like like a bank and find your where's the liquidity, where are the banks going to hold their money. So as we were going down, you can see that these guys were just taking their heads off here. All right, just doing it by the quarter. Look, we're at the last quarter of this whole range. So as we were taking money off of here, as you can tell, look, we fucking hit the 50%, we consolidated, we hit the 50, and then we went down again. We started doing some things. So now we have these ranges here where we can see where can we put on another position on, right? So off to the left side was he was showing is these levels right here. These levels right here, bro. We're gonna do the whole entire thing. Right? So these are the levels he was showing you. And it's kind of difficult the way he was doing it. It's kind of difficult because you're not used to seeing these things. And once we get into further into the lecture, which is going to be the next video, all he's doing is notice how price is being delivered and how it wants to react to certain things. Okay, that's all he's trying to give you pay attention to. So let's pay attention to this right here. Just let's pay attention to this. All right, so we have all this price action here where it just goes up, goes down, goes up, goes down, goes up, goes down, goes up, and then goes down. All right, here's where it's different. I think, me personally, this is a turtle soup because of the bodies of the candles. So what I'm thinking is that this is ready to go up. Right now, it's ready to engage buy side liquidity. So anyone who's up here, they're gonna get fucked up by tomorrow or by the end of the week. Okay? That's my opinion. That's what I think is gonna happen, and we're probably gonna start engaging in most of all these things, but I think we're just going to engage here, right? I think we're just going to engage here, and we're just going to wait. So, boom, boom. We got order blocks here, but, oh, man, they are sloppy. On the daily, they're very sloppy. This might be it right here. I'm going to be honest with you. So, I'd wait for here. I'd wait for that. Or I'd wait for this. Oh my god, I'm clicking on it, bro. Chill. And I wait for this. Or I'd wait for this. As you can see, it's already engaged this order block, and then it wants to go down. This order block has not been engaged. No matter how like skinny the body of the candle is, it's still an order block because it's still an upright candle. Okay? It's still an upright candle, guys. Alright, so when we're doing this is just pure belief, right? This is pure belief. This is not like, oh, this is 100%. It's just like, do you believe it is? Alright, so that was a fair value gap entry. Boom, goes down. Alright, so what I'm thinking is this. Either we start engaging here or we start engaging here. But I do believe we're gonna start going up, and I think we're gonna go up all the way. Most likely, I'm not too sure anymore. I thought we were gonna get down here because on a monthly, we have these on a monthly scale. We have this, and it's already been 2 years, so it's like we do kind of deserve to go down. We deserve it, but we probably won't. Knowing Trump, he does not like to lose. So if this market goes down like 3,000 points, nigga, that's pretty extensive. All right, so and then we have this, which is the Dow Jones. We already hit an order block here. Let's see how it looks like on a daily. Boom. Okay, hold on. The monthly, boom, just the body, boom. Okay, and then we'll go down to the weekly, hits it. Bodies of the candles are staying above here. We We took out that low. We're inside this fair value gap here, but we did enter this. Oh shit, we entered a weekly. Oh fuck. Yo. That's pretty significant, I'm not gonna lie to you. Alright, so as soon as we entered it, boom, impulse swing. Let's look at it on the 1 hour. Yep, impulse swing. Okay. Yep. Okay, so it did boom, 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 boom. Retracement down to the order block. Doom. Okay, now we're going for buys. Okay. I'm fully convinced. Okay, now we're going for buys. Okay. Oh yeah, we're going for buys. Like, that's it. We're done. We're done going short. Okay. Yeah, I'm convinced we're done going short, guys. You guys can go short, but I think we're done going short. I'm not gonna lie to you guys. But we'll see, bro. We'll see, because I do want to see this area be engaged. This is left open, so it's very difficult to trade. I'm gonna be honest with you. It's just all about belief. If like you don't believe this, then you're gonna be gambling. And I do that not all the time, but I've done it before. And then once you do it so much, you start taking care of how many times you place a trade. Okay, so keep that in mind. Okay, so listen to that. Look, it took this low, but it did not take this one. So is this the rejection block? Yep. This looks like this is the rejection block right here on a 15-minute. That looks good. That looks good to me. But let's see. Because this looks like it wants to go up. So I think it wants to engage the buyers now. Took that out. Boom. As soon as it took that out, went down aggressively. The fact that it went down aggressively means there's short people. There's people that's going short. Okay. Yep. Okay. And we're here. We're at a fucking optimal trade entry. Optimal trade entry. Sorry. I mumble. It's the signs of a genius. Yep. This is a buy. Okay, so maybe a buy. I don't know. But this swing right here lets me know it's a buy. Okay. We did take out that low on the regular trading hours. Okay. This is how I dissect everything, guys. You gotta dissect everything with a clean sheet. Because if I put on the other chart, you're gonna be like, "Yo, what the fuck? This guy's insane." I'd be like, "Yep, I am. I'm fucking insane. Insane for money." See, we got gaps here, gaps there. Open, close. Oh my goodness. Open, close. Poo. Open, close. Poo. A lot of gaps here. Where's the next logical way to fucking engage the market? I think we're gonna end up here. I think so. I'm not gonna lie to you. I think we're gonna end up somewhere around here. And then probably go back down. Let's look at the range. Let's see where we end up at. Yep, that looks like it. Looks like it. Looks like we're gonna engage somewhere up here. Yeah. Hopefully. I do hope so. We're kind of close to this low. It's a daily low, man. Can't hide that, man. This is a September low. And what is this, an August low? And what is this, an April low? Oof. Fuck, man. I really don't know what to believe. Do I believe this monthly order block? Do I believe that this is a monthly order block? Is that what they want me to believe? Or are we gonna fucking go to the 50% of this range? Which I want to do. I want to be here as a buyer. I'm not gonna lie to you, man. I want to be there as a buyer, but if I put this here, this will swing low to this swing high. We're cutting it close. I'm not gonna lie to you, we're cutting it close to the 50%, man. We are. And if I add these three guys, boom, we'd be at optimal trade entry. Oh my god, bro. This can go either way. And for some reason, ICT said, does anyone think we're going to go to 7,000? And I'm just like, yes, I do believe we're going to go to 7,000 because I think the market, since we're creating investors, because this is my whole logic. If you want investors into the market, you're going to have to discount the market. Yes or no? Yes. Are we in a discount in the overall range of the monthly? No, we're still at premium price. Discounted price is down here. All right. Oops. Discounted price is down here, and that's why I'm looking at this order block, this section of price action, and I'm just like, this would be a perfect entry, but it would look too much like this. You know, too much. January 22nd, this is fucking Biden years. Oh my god, a whole year of just down. A whole entire year, and then up 2023, all the way to 2024. He gained the market going up, two years up, and then 1 year down, and then the second half up, and then another year up, but it was a sketchy type of up. It was sketchy as fuck. Ooh. This is considered a market shift, bro. The market has shifted here considerably. Because if we take this into account of what a market shift looks at a higher time frame, it looks exactly like this. All right, so what can we look at? Okay, so now on a weekly, we can engage here. And what is that? The area that I want. Oh, you fucking sneaky bitches, dog. Look at, oh my god, that's the weekly that I want. That's the weekly imbalance that I want. Okay. 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 Now this starts to make sense. You see? Now it starts to make sense. Because now if this turns green by Friday, by next week, we're going back down. That would be the first retracement of an imbalance entry of the whole month. On a daily, very unclear, but on a weekly, very clear that where it wants to go. Okay. Okay. 50% wick entry of this weekly. Oh, wow. Oh, wow. You were hiding? See, this is why I need to look at the weekly, bro. See, like, I'm breaking it down for you. Like, this is like, now it makes sense why it wants to reverse on the daily. Once it makes the reversal, hits the weekly wick right here, wants to go up. And that's why you see me with a buy. All right, and that's why you see me with a buy like all the way up here. Like I'm trying to get it up here. See, that's swing banner swing pips, motherfucker. That's why I call it banner swing pips. And there's an order block here, man. Whew. Takes out a weekly high. Takes out Friday's high, maybe. It could do that. It could do that. It could take Friday's high. It can fucking do that, man. Like that's what I'm saying. Like now we're in a 4-hour. Now let's put electronic. Okay. It can do that. Okay. What do we have here? Up move before the down move. This would be considered an order block, no? So I do this. Boom. This is just me following logic. I just do that. Right? But we have this weekly opening gap up here, which is right here, which is the close. I gotta make this skinnier. I gotta make it black because it's a black hole. The event horizon close 1350, and then now the open, which is 5600. Boom. So that's our event horizon, and it's lined up with a weekly imbalance with a 4-hour order block. What's the open on this? 25.25. Okay, I'm gonna make this a little bit skinnier. Boom. Okay, this is my daily, weekly, monthly. Okay, so my daily, weekly, monthly. If we engage the buyers or the sellers who put the sell stops up here, I mean the buy stops here, whoever went short here, we engage this bull trap here for a weekly imbalance entry to go short. Oh my god. Yo, let me see what we got going on here. This week, apply settings. Okay, this is what we have tomorrow. This is what we have Thursday, and we have nothing Friday. What's next week gonna look like? PMI, GDP, core index. Okay. So if I put on my thinking hat, I'd be like, okay, boom. And then boom. That's me. That's me. I don't even want to see this. That's too much. I think that's too much. But let's see how that looks on the lower time frame. Hold on. How does that look? That looks like way too high. Oh my god. It'd definitely be at a premium price. But these markets don't want to go up or down. Definitely at a premium price. Holy. And look how perfectly it fits in between these. The fuck, bro? How am I finding this? Oh, order block right here. Oh, man. Let's see if we engage this. There's a chance we might engage that. We might. We just might. We just go all the way up here. Right? Take out those equal highs that were here. Oh, man. I think that's too high. Be honest with you. I think this is it right here. Or this right here. Yeah, man. I'm starting to think this is it right here, boy. that's the last leg. Then leg, retracement, leg, leg, leg. All right. So this is what he means, okay? So when you're doing top-down analysis, you can pick and choose what you want. See, I already picked I already chose mine, which is buys right now, and it's buys up to here. Let me show you. Positions, orders, execution. No, not execution. Fuck that. What is that? Right there. Yeah, sure. You can show that, bro. I don't care. All right. So this is my buys, right? So if I'm buying here, I'm letting go up here, just off of pure principle. You know, just off of pure principle, I'm just letting go right here. Just out of pure principle, I'm letting go right there. That means this candle will turn green. And I think it'll stay green till Friday, until next week. And if not, on Friday, we make a way down. I'm thinking too much far into the future, but I do believe this is where price wants to go. We take out a weekly stuff here. We got a nice gap here, man. Nice gap. Got a nice gap. Got a nice imbalance. Right here, at home. You can't do any better than this. You can't, dog. You can't do any better than this, bro. Like, you can't. What's the low on this? Holy 66675. Yo, we gotta look that up, bro. We'll be like, yo, what the fuck does that mean? 6250. 6250. Okay. I'm gonna go off by the scratch of the ear on my right side, so I might be right. Alright, so let's document this. Hello, Twitter. It's 10/27, March 18th, 2025, and this is price right now, and I'm predicting we're gonna get into here on a weekly. I don't know what's gonna happen once we get into here, but I do believe we're gonna get into these levels. I do believe. I do believe. Yeah, we're gonna get into these levels, bro. Got a nice little turtle soup here. Entry here. Aggressive. Oh my god. Okay. This looks like it's still gonna go up. Holy. This is what price doing? Oh my god, look at it. What time is it? 10:30? Just straight consolidation, bro. This might come down. This might come down again. Just out of pure principle. Alright, so I'm gonna get back to this. I think we did enough today. It's two in the afternoon. I mean, we did 2 hours. So I only did 3 days. Oh my god, it's gonna take forever. We'll do it tomorrow, bro. Fuck it. We'll do it tomorrow during the morning. Or if I can't sleep because I drank coffee, let's see.